Good afternoon, everyone. It is February 20th of 2024. Hope that everyone had a great long weekend. If you did get that Monday off, obviously markets were closed, gave a good breather. We obviously had a big check back last week, specifically around, what was it, I think on Tuesday, we had that big check off in the market as it related to the inflation report. Again, we were expecting that. If you look at the reports, our weekly reports going back to the week before or 2 weeks ago, short term stocks were overbought. And that happens. We were up 14 of 15 weeks. Guess what? Sometimes you get stocks that pull back a little bit. And, we look at last week's action more or less as stocks letting off some steam versus, say, a big nefarious inflation report. Now, we, of course, are of the view that inflation is not over. We don't think it's going back to 2021 or 22 levels, but we're still at 3.9%. And we're going to talk about what that means for stocks and for bonds this week. And more specifically, where can we create some value in this market where there's some overheated areas, but also some areas that remain fairly cheap. So let's get into the presentation. Now, for this week, we're calling the presentation Stocks Went Down, Buy or Sell. And again, if you remember the big message that we've been going with to investors over the last few months is that the market is not a monolith, right? So it's not as simple as saying, I'm going to buy or sell the S&P 500. We got to pick our spots. So the three big things this week: why did the inflation report cause stocks to go down? Number two, we got a big moment right now for interest rates. We're right at a big pivotal technical level, a convergence of multiple resistance points. And then lastly, our energy in China actually starting to heat up now. Now you can see here, chart over here on the right, we had that big check back last week. Again, it was really centered around one day, and you actually had a bounce Thursday and Friday. So real quick here, yes, inflation came in a little bit hotter than expected. Did we expect that? Yes. If you look back, again, we've been talking about this for the last couple of months. People were getting way too optimistic on inflation. A lot of the underlying components were not back to 2%. We have a strong stock market. We got strong employment market, and we got a lot of stimulus coming into the economy this year. So I'm not sure why everyone is assuming that the Fed's in a rush to cut interest rates, because inflation's still around 3.7, 3.9% or so. That's not an environment to cut. But overall, the foundation of the market still actually looks pretty good. We look at earnings, 81% are beating. Valuation, 15.8 times for the S&P when you strip out the Magnificent Seven. With the Magnificent Seven, it's a hot market. It's around 21 times, right? But that's what we were talking about, picking our spots. The Magnificent Seven is that bubble that everyone and their grandmother and their grandfather and their great-grandmother are all piled into because those companies can do no wrong. Remember, price is our North Star. So you strip that out, market looks okay, 15.8 times earnings. Breadth is starting to expand in areas outside of the Magnificent Seven while contracting within the Magnificent Seven. Lots of dry powder out there, record amount of cash. And then, of course, sentiment has already flipped the bearish short term as people got hit last week. And again, we want to be cognizant of that. Again, longer term sentiment still a little elevated, so we could see stocks pull back a little bit more. Again, we would be more concerned around those Magnificent Seven or those top heavy areas of the market. Cyclicality continues to lead, though. When we look at transports relative to utilities, as you can see here, this is the relative strength chart of transport stocks versus utility stocks, or good economy versus bad economy. That's another way to think of this chart. Good economy is leading bad economy, and we want to see that. That's a good symptom for the market. If this was the other way around, going like this, that's no bueno, right? We don't want to be looking at a market where utilities are outperforming transports or bad economy is outperforming good economy, right? So consumer, transports, those areas of the economy or of the market are continuing to break out on a relative strength basis. And that's what we love to see. And again, we talked about those investor flows last week. I want to bring this chart up again. Institutional money flows, retail money flows into cash or cash equivalents such as money market at 1.4 trillion, while you've had a net outflow of 212 billion in equities. I think a lot of it is tied to concern around the election this year. And again, yes, elections can offer noise, but if you look back to whether you're talking a Republican or Democratic administration or Congress, stocks go up in either, stocks go down across either. There's no statistical evidence that one party is better than the other or one president is better than another. Quite frankly, it's a 50-50 coin flip, right? So skepticism plus cash, we like that setup. There's a ton of cash sitting on the sidelines, not making money in the market. So why did stocks get hit? The easiest explanation, stocks were overbought. They were up 14 of the 15 weeks. It's okay for stocks to go down sometimes, right? Especially when you're this overheated. We've talked about this the last couple of weeks. We're not surprised by it. Market was pricing in 7 interest rate cuts. That's ridiculous. We're sitting at 3.9% inflation, as we'll show here in a couple slides. And inflation, as the report showed last week, is heating back up a little bit. So that equals less rate cuts. So you got to dial back some of those risk expectations, especially if you're in high valuation tech or high valuation growth, which we're not right now, but those areas are especially susceptible to these types of pullbacks. So if we look at inflation, obviously still at 3.9%, okay? So if you start to cut rates dramatically at 3.9%, you can expect inflation to pop right back to 5%, and suddenly we're talking about the Fed having to go to 7% interest rates. And the Fed's cognizant of that. I actually think they're doing a pretty good job of lowering expectations around how fast they're going to cut rates. But for one reason or another, the market sort of ignored that in December and in January. We were not ignoring that. We're paying attention to areas of the market that offer value and can do well when rates are going up as a response to a strong economy and tight labor market. We can see here, hospital services, auto insurance, personal services, all of those swung back to the upside in the month of January. So economy is strong, unemployment is low. We just don't see why the Fed would be in a rush to spend a lot of these bullets when the economy remains strong and inflation's double their target. It just doesn't make any sense to us. And this leads us to a big moment in yields, right? So right now you have a big resistance point right here around 4.25%. I think we did a pretty good job of calling that bottom here in rates. But now the question is really going to be, do they break out above this or they break down? We believe in technicals. We don't need to be a hero here and try to make a call and saying, hey, we're making a call and rates are breaking out back to 5 or they're breaking back down to 3.5. Honestly, our approach is let's see what the market does. And then let's see how assets react. If you had told me rates were going to go from 3.5 to 5, I would have told you that technology would have sold off last year. And that was our opinion, but tech rallied, right? So let's see what asset prices do in reaction to the direction that rates choose to go from this point on. And then let us read those tea leaves as to what it might mean for asset prices, value versus growth, or for the market as a whole in the economy. The market tries to give us these clues and these tea leaves, and it's our job to try and read that. So we're more concerned about the directional move in asset prices relative to each other and in absolute form versus trying to make a call right here, because this could go either way. And valuations do matter, right? I know that for those who are 99% long the Magnificent Seven, that seems like just an absolute heresy to say. But the truth is, prices matter. And if we look at valuations, when you look at forward 12-month returns, those highest returns are in those assets that are in the sub 10 times earnings category or anywhere from 10 to 12, 12 to 14 times, or even 14 to 16 times. Where they are below average is when you're buying a bunch of assets that are trading north of 20 times earnings. Now, are there stocks that can work in that environment? Of course there are, right? Especially when you're getting strong momentum behind momentum begets momentum type of thing. That said, there are signs that the Magnificent Seven are starting to deteriorate, right? And we want to pay attention. The leader of this big move, of course, has been NVIDIA, a fantastic company. No one questions that. It's a real company, real earnings. They are the leader in AI. Not a lot of competition really outside of AMD. But I will remind people that Cisco won the internet. And when Cisco ran up in 2000, the call was that they will win the internet. But not only did it happen, but when it did happen, the stock peaked. And to this day, Cisco has never revisited that $80 level. So if you bought Cisco here in 1999, you're down today, even though they did win the internet. And when I say won the internet, they equipped all of the back end to build the internet from scratch. They were the prime equipment winner. So they did everything that the analysts prognosticated would happen. But the stock still peaked. Why? Because it was expensive. It was really, really expensive. So NVIDIA will win AI? Maybe they will, right? But will it matter? Price is our North Star, right? These are the covers of Business Week and Fortune way back in 1999. Is John Chambers the best CEO on earth? Is it too late to buy the stock? John Chambers' new plan to rule the internet. Of course, who ended up ruling the internet was Amazon, was Facebook, was Microsoft. You know, outside of Microsoft, the other two companies no one had really paid much attention to, right? So we want to pay attention to price. Price is our North Star. And we're already seeing signs of deterioration. Apple continues to deteriorate on a relative strength basis, right? You may say, oh, come on, Rob, you're making too much. It's gone from 200 to 182. Okay, but the market has gone up. And Apple has actually been flat since 2021. That's what we pay attention to, is the relative strength. As the market's going like this stock is going sideways or not up as much or down. So from a relative strength point, it's breaking down. And this is Apple's chart of a relative strength versus the S&P 500, and it continues to break down. So sometimes, in many cases, not all the time, that can offer a leading indicator as to what may be happening in the future. When we look at semiconductors, the center of the bubble, right? The center of the center of the center of the bubble. Believe it or not, only 40% of semiconductors have outperformed the S&P 500 so far. It's really top heavy between Taiwan Semiconductor and NVIDIA and AMD and ASML. Outside of those, you actually start to see a lot of companies that are underperforming in the semiconductor space. Again, why is that happening, right? Is that a sign of things to come? Will that virus of underperformance spread up to the top leaders? We want to pay attention to that. You know what's not expensive? Energy, China, the banks. They had a pretty good week last week, despite a lot of the other areas of the market that pulled back. Price matters. And from a seasonality standpoint, you're heading into the spring driving season with valuations on energy stocks that are low. And believe it or not, quietly, oil is almost back to $80. No one's really talking about that. Oil's almost back at 80. It's gone from 70 to 80 and you hear nothing about it. So again, very interesting. And small caps are responding. If you think of our market foundation slide that we've talked about week in, week out, we didn't include it this week, but we're looking for value over growth, small cap over large cap. And interesting enough, small cap stocks have really responded to the recent sell-off, right? With another breakout higher. Value, cyclicality, steep yield curve. What is the market trying to tell us here? And then, of course, if we look at China, another more interesting headlines. Is Hong Kong over, right? MSCI to remove swath of China stocks from its indexes. This just pair this up with the Economist cover and everything else. You're getting the classic press freakout over a certain asset class. We've been chipping away at some of these Chinese stocks. They're really cheap. 8 times Alibaba, 7.5 times JD, and you can go down across the cap curve. Some very high quality companies that are very cheap. So in summary, it's important to read the tea leaves, ladies and gentlemen. It's okay if stocks take a breather. They're allowed to go down sometimes. 14 to 15 weeks, they went up. Guess what? Now it's 14 to 16. So not a big deal. Less concerned about the direction of rates, okay? We're more curious about how prices react to the direction that rates choose. And that's how we will decide how we proceed with the portfolios. And then lastly, China and energy look very cheap. They look very attractive here. That's what we got for you this week. 888-543-3776. Thank you again for your time. Thank you for your consideration. And if you have any questions whatsoever, please feel free to give us a call and we'll be happy to answer any questions that you have. Thank you again and have a fantastic week.